You land in a foreign paradise, open your laptop, and assume your financial obligations to your home country vanished the moment you cross the border. This is the most dangerous assumption in modern wealth building. Right now, a silent, six-figure tax trap is waiting to trigger the moment you file your next return, and ignoring it could wipe out a decade of your hard-earned capital. The concept of location independence has evolved from a fringe lifestyle choice into a dominant strategy for global wealth accumulation. Modern professionals, investors, and entrepreneurs no longer need to anchor their operations to a specific metropolitan hub. We are living in a golden era of global mobility, where digital nomads and modern investors can engineer their lives to optimize freedom and scale their capital. However, the international tax system was built for the industrial age, not the digital one. The framework is a rigid architecture built for physical factories, static employees, and centralized payroll systems. It is fundamentally ill-equipped to handle an individual who writes code in a coastal villa, serves clients in a different hemisphere, and routes capital through decentralized networks. This friction between a modern lifestyle and archaic legislation creates a breeding ground for catastrophic financial errors. The disconnect between where you sleep, where your clients reside, and where your passport was issued creates massive unseen liabilities. Today, we tear down the romanticized myths of the tax-free nomad. We explore the unforgiving mechanics of global tax residency, the brutal reality of state-level domicile laws, and the exact day-counting rules that could either save you over $100,000 or leave you facing a financial audit. Here is the definitive blueprint to protect your capital while working from anywhere. Module 1. The double taxation trap and the nomad fallacy. The journey begins with a fundamental misunderstanding of international law. You cannot outrun the tax authority by changing your accommodations every month. Many remote workers believe in the myth of the perpetual traveler. They rely on the 183-day rule, assuming that if they stay in a location for fewer days than that threshold, they owe nothing to the host government. They hop across borders, assuming they remain invisible to the global financial system. This creates a severe vulnerability. Tax systems do not require you to settle down permanently to claim a percentage of your capital. If your home country taxes its citizens based on citizenship or domicile, they maintain a legal claim on your worldwide income no matter where you travel. Meanwhile, the host country where you consume local resources might tax your capital because the physical labor was performed within their borders. Imagine generating $250,000 coding software from a beachside villa in Europe. You rent a co-working space, enjoy the local infrastructure, and scale your operations. You assume your short stay shields you from local obligations because you plan to leave before the year ends. You also assume your physical absence shields you from domestic obligations back home. But when these two opposing legal frameworks collide, you face double taxation. The local tax authority notices your sustained presence, tracks your local bank transactions, and claims jurisdiction over your revenue. Meanwhile, your passport country demands their standard percentage. The exact same capital is claimed by two sovereign entities at the same time. Your margins collapse under the weight of dual tax brackets. The solution is never perpetual motion. The solution requires the deliberate establishment of a fiscal residence in a jurisdiction that serves your strategy, leveraging tax treaties to determine the center of your vital interests, and severing ties with the system that penalizes your growth. Module 2. The sticky state domicile nightmare. Crossing an international border might sever your physical presence, but it does not sever the deeper legal roots tied to your home state. This trap targets citizens from aggressive tax jurisdictions. Moving abroad offers federal benefits, but local state governments operate on different, more aggressive rules. Certain jurisdictions are known as sticky states. They utilize a concept called domicile, which is defined as your true, fixed, and permanent home. Imagine moving to a wealth haven in the Middle East to enjoy a 0% income tax environment. You execute your business strategy, retaining all your profits to reinvest in digital assets and real estate. 3 years later, you receive a devastating notice from your former local government in North America. because you maintained a storage unit full of old furniture, renewed a local driver's license for convenience, kept an active voter registration, or held a local bank account. The authorities determine you never abandoned your original domicile. They categorize your overseas relocation as a mere temporary absence. They demand their percentage of your entire global income earned during those 3 years, plus late penalties and compounded interest. The burden of proof rests on your shoulders. Tax authorities presume you remain a resident until you prove beyond a doubt that you abandoned your old life and established permanent roots elsewhere. A temporary digital nomad visa does not count as a permanent move in the eyes of an aggressive auditor. You must systematically dismantle your domestic footprint, relinquish your licenses, close redundant accounts, and sever the ties that bind your capital to a high-tax state. Module 3. The Physical Presence Test Catastrophe. There is a powerful mechanism in the federal tax code known as the Foreign Earned Income Exclusion. This legal framework allows eligible expatriates to shield a massive portion of their active income from federal taxation. For those filing in the upcoming years, this exclusion shelters well over $130,000 of wealth. However, the mechanical requirement to claim this benefit is unforgiving. It is called the Physical Presence Test. To pass, you must be physically present in a foreign country or countries for 330 full days within a consecutive 12-month period. Imagine you schedule your international travels with mathematical precision to maximize your capital retention. You spend 11 months abroad building your enterprise across Asia and South America. You return to your home country for a brief family event, leaving a margin of error of just 2 days. During your visit, a sudden medical emergency, a global health restriction, or a severe weather event grounds your outbound flight. You remain trapped inside your home borders. You cross the allowed threshold. You miss the physical presence requirement by a single day. The tax authority offers zero sympathy for unforeseen circumstances. That single extra day disqualifies your entire 12-month period. The 6-figure income you assumed was shielded is dumped back into your highest taxable bracket, triggering a massive tax bill that shatters your financial projections. Furthermore, a qualifying day is defined as a full period of 24 consecutive hours beginning at midnight. Time spent over international waters or airspace does not count as being in a foreign country. Tracking your transit down to the hour is a mandatory compliance practice to protect your wealth. Module 4. The Corporate Permanent Establishment Risk. A hidden danger of borderless work involves the entity paying your salary. If you operate as a traditional employee for a multinational corporation and relocate without explicit structural authorization, you become a walking liability to your own company. By performing core business functions from a foreign location, you can trigger a permanent establishment for your employer. This legal concept means the host country determines your presence, creates a taxable corporate branch within their borders. Imagine being an elite engineer who transitions to a remote tropical island, enjoying the pristine views and leveraging geographic arbitrage to maximize your savings rate. You use a digital nomad tourist visa to enter the country, assuming your immigration status protects you from financial scrutiny. You continue writing code, attending virtual meetings, and pushing updates to your company servers. Months later, the local government sends a staggering corporate tax assessment to your company headquarters. Because you conducted revenue-generating activities within their borders, the foreign jurisdiction declares that your employer now operates a taxable business in that country. You have exposed your company to complex reporting obligations, foreign corporate taxes, and severe compliance penalties. The standard corporate response to this breach of protocol is immediate termination, leaving you stranded without income in a foreign nation. Location independence requires structural compliance. You must align your immigration status, your fiscal residency, and your employment contract to ensure you do not jeopardize the enterprise funding your lifestyle. Module 5. The Self-Employment Tax Illusion. The final trap catches the independent contractors and remote entrepreneurs who assume moving abroad grants total tax immunity. Many freelancers claim the foreign income exclusion, shielding their federal income tax, but fail to realize this exclusion does not apply to self-employment taxes. These are the mandatory contributions funding domestic social programs like state healthcare and retirement systems. Imagine setting up a high-ticket consulting business from a cafe in Southeast Asia. You structure your client contracts, deliver immense value, and keep your total income below the federal exclusion limit. You assume your tax liability is zero. But because you operate as a sole proprietor or independent contractor, you remain responsible for a severe double-digit tax rate on every dollar of net profit. The exclusion only reduces federal income tax liability. It leaves self-employment obligations untouched. This oversight drains 15% or more of your wealth before you even account for living expenses. Unless you operate within a country that holds a specific totalization agreement with your home nation, you remain liable for these massive payroll taxes. A totalization agreement is a treaty designed to prevent dual social security taxation. But if your host country lacks one, the financial drain continues. The modern investor must restructure their enterprise. By forming an offshore corporate entity or utilizing specific international tax treaties, you can legally bypass these hidden fees and retain the capital necessary to scale your wealth. The core lesson is clear. True financial freedom is not achieved by ignoring the rules. It is achieved by mastering them better than anyone else. Your location independence remains fragile unless you construct a rigid legal foundation beneath it. You cannot scale a global enterprise or build generational wealth while leaving massive regulatory blind spots in your strategy. Every uncalculated border crossing, every forgotten bank account, and every misclassified employment contract acts as a ticking liability. Once you eliminate these critical errors and protect your downside, the next logical step is to pivot toward an offensive strategy. You must move from mere compliance to active optimization. To uncover the frameworks the ultra-wealthy use to eliminate their international tax burden, click the video on your screen titled The Digital Nomad Tax Strategy: How to Legally Pay 0% in Taxes to Build Your Ultimate Wealth Architecture right now.